Good evening, ladies and gentlemen. Afrimat Limited is listed on the JSE. We're a material supplier and listed in the construction and material sector, so we're not a normal mining company. And we started our lives as a small family-owned quarrying business that we grew into a national supplier. We have also diversified the business a little bit. We still do aggregates. We believe that we are probably the biggest supplier of aggregates in South Africa. We also started doing industrial minerals in our open pit mines. We supply a metallurgical dolomite to the likes of ArcelorMittal, Highveld Steel and others, and also other users of the product. We also do limestone out of a limestone mine and metallurgical quartzite. We add value to some of the byproducts out of our quarries through concrete brick and block making, and we use ready-mix concrete as a conduit for selling stone. We're not as fortunate as Lalau to make money out of concrete. We'll still find out from them. In the 8 years that we've been listed, we haven't been able to make money there, but we make money out of the stone that we sell there. It's probably because they charge us so much for the cement. Looking at our company strategy, we see ourselves as open pit miners with our roots in quarrying. We only deal in locally priced commodities, markets that we can understand, and that we can understand how to position ourselves to leverage the pricing structures. We make sure that our operations have one of the following three competitive advantages, either through our geographic location. We happen to own the quarry that's closest to Nkandla. If we can't do it through geographic location, we also look at unique metallurgy. We own the best metallurgical dolomite sources in Gauteng. And then the last one is a structural cost advantage, where we can find an operation with some structural cost advantage over our competitors. And we've positioned the business in that way. Our culture is highly entrepreneurial, and we do a little bit of value adding to some of our products, as you saw earlier. If you look at our footprint, and I'm close to the age of 50, so I've got to put my glasses on when I want to read on the screen here. We have 23 commercial quarries, 7 gravel and sand mines, 2 dolomite mines, 3 clinker operations. Now, this is not the valuable clinker that Lalau was talking about. It's a product that was actually formed through the ash that came out of old generation power stations. And for some reason, that is also called clinker, and I'm not exactly sure why. We have 1 limestone mine, a silica mine, and then we do mobile crushing, giving us the ability to go where work is and drilling and blasting. And then our concrete, we have 9 concrete brick and block factories and 14 ready-mix batch plants, and you can see the footprint there on the map. Just a little bit of history on the business. We've been listed since 2006. There you can see our history on revenue and operating profit over the last couple of years. The 2015 financial year is still running until end of February. That's why the red bar, the second half is not complete yet. We've got a couple of weeks still to try and maximize that. But you can see quite a nice curve over the last couple of years. The interim headline earnings per share, and I used the interim so that I could get the full year to the latest figures. There's the graph, compound average growth rate of close to 20%, which was the target that we had internally for what we wanted to achieve. The balance sheet, extremely strong. We're sitting on a strong balance sheet at the moment. Dividend history, we've been a very consistent dividend player. I've made the joke a couple of times to saying that I don't know if you can remember a couple of years ago when Anglo missed their dividend. We've never missed a dividend. Once again, it's our interims. We normally pay an interim and a final dividend, but once again, to get the latest figures in there, I only use the interims, but the trend of the graph is the same for full year as well as for interims. Now, looking at the space that we play in, there's a lot of uncertainty because of a lot of negative press from big construction companies about the South African construction sector, and it is a big part of our market. If you look at our history, you'll see that we don't fully agree that there's not activity in that market. We just say that the activity has moved. The government's focus is much more on smaller projects, thereby helping them with their BEE drive as well as their job creation drive. And unfortunately, the big construction companies are missing out on that. But if you look at one of our biggest customer bases is the roads market. There's some graphs on the age of our roads, the black being older than 25, red 20 to 25 years. You can see that close to 80% of our roads are outside their design spec of 20 years. There's the condition. All the red, orange, and yellow is roads in need of maintenance. You can see there's a big market out there. Now, you can ask me, are they actually spending? Yes, they are. There's the history of national and provincial road spending since 2006. You'll see in 2010, we spent 23.6 billion for the year. Last year, we spent 33.5, and government is planning to increase that to 44.8 by 2017. And by the way, we found that their budgets and their actual spending in this sector is actually very, very closely aligned. Risks. As any South African business that is related closely to the mining industry will say, labor is a big risk. We have quite a big labor force. But I'm grateful to say that for the last 3 years, we've embarked on a very strong positive program in building the culture stronger in the lower ranks of the business, and it's worked very well for us. We haven't had any incidents in the last 3 years. The country risk, South Africa, we've just started our operation in Mozambique. We are looking at other parts of Africa as well to try and mitigate that risk a little bit. One of the markets that we supply is the steel industry. Once again, it is not a very dominant debtor in our book, and we have very close control over that. And the macroeconomic threats, I think we're all aware of that. And the important thing is to be consistently on the lookout for changes in your environment and making sure that you adapt quickly enough. This is the last slide. This is just the investment case. Over the last 5 years, we've seen about a 450% growth in share price. It's been a consistent grower. We're grateful for that. The fundamentals of the business is healthy, and we're looking forward to an exciting future for the business. Thank you very much.